I'm delighted to be speaking to Gary Robertson today. Gary has been an accountant all his life. He's a chartered management accountant, and for the last 20 years, he's been working FD level for companies with a turnover up to about £40 million. Gary, good morning to you.
Morning, David.
Really pleased to have you here and giving some insightful knowledge about finance and accounting, really going over some terminology which people may not be completely familiar with. I just really want to start at the beginning. I'm sure people have got accounting packages such as Sage, but really there are terms in there we don't necessarily know what they mean. So let's just start at the very beginning here. What is a ledger account?
Okay. Well, I think what you say, many will have accounting packages. Quite a lot of sole traders won't have even that, perhaps. And you might find if you go right down to the simplest level with a sole trader, he might be noting down everything he spends, everything he receives, either onto a spreadsheet or perhaps into a manual cash book, and putting all the receipts and paperwork into a cardboard box and just giving that spreadsheet or cash book to his accountant with the box of receipts at the end of the year. Um, and what the accountant will then do with all of that information is key it into a system. So if you can imagine all of those transactions for the whole year, all of those ins and outs going into one big long list, that big long list of transactions is effectively your financial ledger. But that big long list is not really good enough for either you as a business owner or for your accountant to do what he needs to do. Because if you want to know what were my total sales for the year, perhaps, or what were my materials costs over the period, you're not going to want to go down that list saying, well, there's one, adding them all up. So when your accountant types all of your transactions into his system, he will type them into categories, into like little bucket categories. One for sales, one for materials costs, one for telephone costs, one for vehicle costs. Each one of those buckets is a ledger account. So ledger accounts really are categories of revenue and cost, and all of the revenue account and all of those ledger accounts added together equal your financial ledger.
Brilliant. That's really well explained, Gary. Thank you. That's actually made a lot clearer for a lot of people, I'm sure. So, Gary, tell me what is a balance sheet and what is a profit and loss sheet?
Okay, so moving on from the point that we were at with our accountant, where he has taken all of that cash book information and turned it into a ledger filled with ledger accounts. He will then turn that into financial statements, both for his use for calculating your taxes and for your use to understand what your business has done for you for the year. So the two primary schedules that your accountant will prepare for you are your profit and loss account and your balance sheet. So each ledger account will fall into one of four categories. There are income accounts, there are cost accounts, there are asset accounts, and there are liability accounts. And every one of your ledger accounts will fall into one of those four categories. In a simple business, income is sales. Expenditure or costs are all of your purchases. The asset accounts are everything that the business owns, and the liability accounts are everything that the business owes. And every ledger account will fall into one of those four categories. So when your accountant prepares your accounts, they will take all of the income and expenditure accounts, all that list of income and expenditure ledger accounts, and they will summarize those into a one-page document, your profit and loss account, that will show you in a much more easily digestible way what were your sales, what were your costs for the year, and therefore what was your profit for the year, hopefully not loss. Which is going to sort of give you at a glance how your business has performed for the year. Then likewise, he will take all of your asset and liability accounts, and he will summarize all of those into a balance sheet statement. And that balance sheet statement will tell you at your accounting date everything that your business owns and everything that your business owes. So examples, I guess, of asset accounts will be cash at bank, any premises that the business owns, any equipment, motor vehicles, and any money that's owed to you by customers. Likewise, liabilities could be bank overdrafts, it could be bank or finance company loans, or it could be what you owe suppliers or what you owe the taxman. But again, the balance sheet will summarize all of those, what you own and what you owe items into one sheet. So as your business grows, just having your accountant prepare you your accounts, your profit and loss, your balance sheet, and your tax return each year is no longer enough for you. The information that's contained in your accounting ledger is a really valuable tool to help you keep track of how your business is performing. You can use that information to tell you which projects were profitable, which projects were less profitable. Are some things costing you more than you were expecting them to have costed you? Are we collecting payments from our customers quickly enough? Are we carrying too much stock or not enough stock? So so management accounts are typically a pack of financial schedules that will often be produced monthly, or most typically monthly, comprising, yes, your profit and loss account and your balance sheet, but also drill down detailed schedules, drilling more into some of those line items, so you can better understand the detail behind your sales, the detail behind your costs, and your collectibles, and how cash is moving. And then that way, that information can be used by management to manage the business better, understand the business better, and make good, timely decisions.
Yeah, brilliant. Yeah, really, really good explanation there. That's going to be really, really useful. So we know fundamentally cash is so important to a business, Gary. Perhaps you could explain what a cash flow statement is.
Yes, you're absolutely right. Monitoring cash is critical to a business. If cash runs out, employees and suppliers can't be paid, and a business can fail. And although it sounds ironic, even profitable businesses can run out of cash if they don't manage it correctly. If a business is working on a very big project, that is quite lengthy in duration, and most of it is paid at the end, then the business is going to be paying out for materials, wages, and services for many months before receiving any income. And that's when a profitable business can run into difficulty. And that's why it's so critical to monitor cash, as well as sales and profits, because often they are out of step with one another. So what a cash flow statement is doing is monitoring the actual cash that is coming in and out of the doors of your business. because whilst you've recorded a sale, your customer may not have paid you yet. That might still be in receivables in your balance sheet. On a cash flow statement, you will only see revenue from customers when that cash has actually been received. So what a cash flow statement is doing is showing you the reality of cash in and out of your business, so that you can closely monitor it, anticipate what is happening and what's going to happen, and be able to give management the opportunity to make sort of good, timely arrangements with banks and lenders if necessary, to ensure their business can run smoothly through the peaks and troughs of normal business activity.
Understood. Yeah, I think cash really is, that's that absolutely vitally important to make sure you have got enough, as you say. You can also grow too quickly, take on too much business, and have too much owing to you. You can't finance the actual business. So actually a regulated business growth sometimes is the way to go, and not grow too quickly purely for your cash position.
Absolutely right, and in some small and young businesses, the other mistake that can be made is perhaps proprietors taking too much out in dividends early on, not anticipating perhaps a heavy expenditure period the following year.
Yeah, exactly, or a big tax bill which they haven't
Yes,
accounted for.
absolutely right.
Gary, one phrase that we see in the press is EBIT and EBITDA. Could you please just explain what they actually mean?
Yeah, sure. Well, EBIT is earnings before interest and tax. So that is profit before any interest or tax payments have gone out. And typically that is a popular measure because it's considered that in many ways that is a fairer representation of how well a business has performed and how good a job management are doing, because arguably interest rates and taxes are either outside of the control of management, or in the case of taxes, the better you do, the higher your tax bill is likely to be. So in earnings before interest and tax is a good measure of how well management have done. EBITDA is a progression of that, insofar as that is earnings before interest and taxation again, but also depreciation and amortization. And depreciation and amortization is effectively our accounting terms for the reduction in asset values that a business will take over time. But they're not entries that reflect on cash, because you will have bought your asset, you will have bought your company vehicle perhaps 5 years ago, and the value of that vehicle will be spread over the life of it. So whilst all the cash went out on day one, perhaps, you will depreciate the vehicle over 5 years. So you will take a depreciation charge every year. So where your profit and loss account will show a depreciation charge reducing your profits, effectively that depreciation isn't reducing your cash. So what EBITDA does is adjust your profit to more closely approximate to cash flow.
That's absolutely brilliant. That's been thoroughly insightful, I think. Some great answers there, explained very, very well. Really like to thank you for your time. We're going to wrap up there because we are actually out of time, unfortunately. But yeah, thank you very much indeed.
You're very welcome, David.